Hey everyone, and thanks for jumping back into the Equityverse. Today, we're going to talk about the S&P 500, and we're just going to be providing a general outlook. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. So to provide a quick recap on sort of expectations for the S&P 500, one of the things that we said back in July was that it was likely topping out and was probably going to undergo a 5 to 10% correction. And we actually got a little bit more than that. I mean, it actually dropped about 11%, which is a more sizable drop than it normally gets in Q3 of the pre-election year. The reason that we sort of talked about this idea of a seasonal correction is if you just simply go look at the S&P 500 in 2023, or sorry, in like 2019, you can see that we had a correction around that same time. Same thing in 2015, a correction in like August, September timeframe. Same thing in 2011, and so on and so forth. And what's interesting is if you take the average of all prior pre-election years, you get a chart that looks like this. And then if you overlay 2023 onto it, that's what it looks like. So, back in July, we were looking at this and we're like, well, the average ROI of the S&P at this point in the year is only about 12% off the yearly open in pre-election years. But we were sitting 20% off the yearly open, right? A much more significant move to the upside than what is historically seen in, at that point in pre-election years. And so we suggested we would likely get a correction that would take a couple of months. But of course, corrections don't necessarily last forever. And so we sort of were open-minded to the idea that things could turn back around, especially as we get into the November timeframe. Now, we put out a video a couple of weeks ago, and I believe we put it out somewhere around this point over here. And we said that when Yellen issued shorter duration than the market was expecting longer duration, and that didn't happen. It was much shorter duration the market was expecting. We said that that's both bullish for both stocks and bonds, right? Bullish for both stocks and bonds. And the reason for that assumption, the reason why we said it was bullish for bonds, is because issuing shorter duration meant there wasn't going to be as much, supply that had to get absorbed, right? There wasn't going to be as much pressure on the long end of the yield curve. And you can see that TLT just after that, right? I mean, it had a pretty sizable bounce, right? TLT went up about 5%. Right now, it's only up about 3.5%. Now, if you're not familiar with TLT, this is a 20-year Treasury bond ETF. But basically, if the long end is going down, right? If the long end yield curve is going down, then something like TLT is going up, and the vice versa, right? So if the long end yield curve is going up, then the bond's going down. Okay, so because of Yellen issuing shorter duration than the market was expecting, we said it's bullish for bonds, okay? And at least short term, right? Like it doesn't mean that this has to be the low, like the macro low. I mean, it could be, but it doesn't mean that it has to be. We said it's short term bullish for both stocks and bonds. And if it's short term bullish for bonds, then it's going to be short term bullish for stocks in this environment, right? So TLT went up about 5% from that last video. The S&P, I think it was somewhere around here. You can see it's also up about 5%. So both of them went up about 5%. So I would argue that our assessment of sort of the most likely short-term outcome was correct. And of course, we can always find a narrative to support that. And only more so can we assume that narrative. If you say a narrative and you say something's going to go in a specific direction because of that narrative, and it actually goes in that direction, then it of course makes you want to sort of double down on the narrative that you said, especially if you got the call right. But there's no guarantee that that's the reason that the market moved, right? It could be due to, it's always possible that the long end of the yield curve went down because of the weak, the weak ISM report, right? We got the the PMI around that same time, and it was showing a fairly weak economy, right? A lot of things in the economy seemed like they were slowing down. So it's always possible that the long end of the yield curve went down because the economy appears weak. And if the economy appears weak, then that means that inflation might not be as big of a deal in the months ahead if we go, if we see an economic downturn, right? So it's hard to know, right? It's hard to know what is the reason, but in the short term, when the long end of the yield curve goes down, that tends to be bullish for stocks. And if you overlay, like let's overlay the 10-year. Okay, so we want to overlay the actually I think I have it over. Sorry, US 10. So if we overlay the 10-year onto this chart, you'll see that really when it broke out from this prior range high over here, right? You can see that that's where the S&P really started to take a big dip. Okay, so the 10-year broke out. When the long end of the yield curve is going up quickly, that is bearish for risk assets. And we are experiencing a bear steepener. Okay, a bear steepener, when you have an inverted yield curve, right? And you think about how is it going to become uninverted, a bear steepener is where the long end of the yield curve goes up, sort of catching up to the short end. Now, we still do have an inverted yield curve. The long end of the yield curve has come back down here. As you can see, the 10-year went all the way up to about 5%, and now it's pulled back to about 4.6%. But this is still technically an uptrend, right? Like there's no guarantee that it is topped, although I mean there's certainly some evidence, it's a good point to say that, but it really depends on how quickly inflation comes down, how quickly the economy slows down at 5.5%. Is it above our star, right? Is it sufficiently restrictive? Is it above the neutral rate? We don't know, right? People are guessing as to whether it is or not, but we don't fully know. But in the short term, when the long end of the yield curve, tops out, like if you look at prior cycles, when it tops out, like right here in November of 2018, when the long end of the yield curve tops out, you can see the short term, it was bullish, right? Stocks went up. If you actually go back to a sort of like a full business cycle that sort of ended in a recession, you'll see right here where the 10-year topped out. In the short term, it was bullish, right? Stocks went up. That was in 2008, and you'll find something similar in the .com era, right? Where the 10-year topped out right here in January. If you zoom in, right here, if you zoom in, I mean, you can see that the stock sold off a little bit, but then they ended up sort of going up to the upside, right? It wasn't an immediate sell-off in the S&P. In fact, from where the 10-year topped out in January, I mean, it really took until basically the following year for the market to really roll over. Now, it's not like the market went anywhere after it topped out. I mean, at the time, the S&P was at like 1472, and the highest it got for the next year was 1549, right? So it didn't really go up that much. It's basically just that it stayed sideways for essentially a year, and then the market sort of rolled over into the .com crash. When the 10-year topped out over here in June of 2007, you can see that the market didn't really start to make a major move to the downside until about half a year later, right? So about 6 months later, it was starting to really put in lower lows. So again, in the short term, when the long end of the yield curve goes down, it tends to lead to a bounce by risk assets, okay? And with Yellen issuing shorter duration, that was a reason for the long end of the yield curve to go down. With the weak economic report that we got, that was a reason for the long end of the yield curve to go down. And when the long end of the yield curve went down, the S&P got a bounce, okay? And then also, if you look at like year-to-date ROI of the S&P 500, oftentimes in the pre-election year, Q3, Q4, you find a bottom. So on average, the low comes on day 292, right, of this correction. And so far, this low came on day 301, right? Day 300, 301, somewhere in that time frame. So, plus or minus within about 10 days of the average, assuming that this is sort of the low that it'll stay above for the rest of the year, which again is no guarantee. But normally what happens in pre-election years, right, is that it gets this correction in September and August, bottoms out sometime September, October, goes sort of chops around for November, and then really starts to trend back up in December on average, right, on average. The ROI on average by the end of the year of pre-election years is about 13% off the yearly open. Right now, the S&P is about 15% off the yearly open. You can see that it's been a lot more volatile, right? I mean, the high was a lot higher than the average, but also the correction went down lower than the average. Just like this move over here was higher than average, and then it came back down to being lower than average. But again, at the end of the day, we got a nice 11% correction or so, and now the market is trying to potentially stabilize. So again, in Q4 of pre-election years, right, if you go take a look at just some of them, if you look at 2019, you can see that it trended up. If you look at 2015, it got a bounce and then just sort of stayed sideways. In 2011, same thing, almost the exact same chart as 2015. If you look at 2007, it basically just went sideways, right, into the end of the year. So there's definitely a lot of things you can look at there. So now, if we look at the S&P a little bit closer, because we said it's short-term bullish, right? I mean, look, if we do go into a recession, then seasonality is out the window, right? Seasonality only works, a certain percentage of the time, right? It's seasonal, but it doesn't mean it's the only thing that matters. It's kind of like how, like post-election years tend to be bullish, but if you get, or even election years, the market still generally trends higher, but go look at, 2000, 2008, 1980, even 2020, the first part of 2020, right, with the pandemic. The market can still go down, right, if you go into a recession. So, but in the short term, there's been a trend that's been broken here, right? So the S&P was putting in a high, and then a lower high, and then a lower high, and then it had a low, and then a lower low, and then a lower low. But then now it's sort of taken out this prior high. So, and that's still in line, generally speaking, with the the pre-election year average, right? You get your correction through August, September, early October, or even late October, right? And then you kind of steady out for the rest of the year, and maybe even go up if other market conditions allow for it. So we did take out this high, and we also, I should note, if you look at the weekly chart, take a look at the weekly chart for the S&P 500, you can see that we actually closed just above the 20-week SMA. So if the S&P can show follow through on this next week, then that would obviously be a better sign going into the very end of the year, assuming we don't get hit with a recession. If you look at like the NASDAQ, it was even more explosive as it got a close above the 20-week SMA last week, and then this week it opened and closed above it. The Dow Jones was a bit weaker than the NASDAQ, but it did at least close the week just above its bull market support band. However, on a weekly time frame, I mean, this, you could argue that this is still lower highs and lower lows if you, are just sort of looking at this like a wick and this sort of part of this downtrend. So that's where we are right now with the S&P. I mean, it hasn't really, if you think about it, the S&P hasn't really moved in years to some degree. I know it's off these lows, it's off these highs, but it's currently at 4,400, which is the same as where it was back in June. It's the same as where it was in April 2022, and in January 2022, and in September 2021, and in July 2021. The S&P really hasn't moved for over 2 years, right? If someone had taken their money out of the market in July 2021 and put it in today, they wouldn't have really missed out on anything except maybe like dividends and stuff. but the market hasn't really moved a whole lot. Now, in terms of, where does it ultimately go from here, right? I mean, it's always possible that it revisits some of these higher prices up here. And if you go look, one thing I like to do is go look at this bear market chart. And the bear market chart, the reason we look at it is not to definitively say that it has to go back down, but it's just to say that it's a possibility we have to keep in mind, especially given the inverted yield curve. Okay. So like if you look at the current bear market, which again, this assumes that this is not the low. If this is the low, then this whole thing over here doesn't need to be here. But if this is not the low, if October 2022 is not the low, then it becomes relevant to at least compare it to analogs, from prior cycles. One of the ones to look at is the one from 1946 to 1949, which was also coming out of a period of high inflation. We had, some lows. We had like a low over here and then another low, and then we got a pretty sizable bounce. So we got another low right here and then another low way over here after 1,111 days. And we're currently on day 676. And if you look at this chart, you'll see that there was sort of a top and then a lower high and then a lower high, kind of like this. And then it had this lower low where it bounced off of, came up, but then still went back down. So that's why you still have to be aware that seasonality is not everything, because if it plays out like this, like what this would mean that we're going into a recession more than likely, right? If we go put in a new low, it's likely because it's a recession, is my guess. Okay. So I think that is sort of a relevant analog to look at, where you can see that it was putting in lower highs and lower lows, and then put in a higher high, and then it still rolled over into a new macro low. So that's something relevant to think about as well. Because I imagine this was a brutal bear market back in 1946 to 1949, because it took forever, right? It took forever to play out, and we just sort of scraped those lows for a while. And I mean, I think the reason that we still have to consider something like this as a possibility, it's not like it has to happen, but the reason we have to consider it as a possibility is we still do have a yield curve that's inverted, right? So if you were to go look at the yield curve, you can see that it's still inverted. It was inverted before the recession back over here, and before the financial crisis. It was inverted before the dot-com crash, and so on and so forth. So we still have to look at it because of that. And then if you look at like ROI to low after yield curve inversion, so this is looking at like the 3-month and the 10-year. And if you look at, say, like this cycle compared to, say, like the financial crisis, I mean, you can see just how the financial crisis played out after yield curve inversion. The yellow dot signifies uninversion, which is when it happened in that cycle. We haven't even had uninversion yet. This chart would suggest that if it plays out like that, I mean, it could still take a long time. If you look at it compared to, say, like the 2-year and the 10-year, and you compare this cycle with the financial crisis, it's sort of a lot more in line, right? Like the analog matches up a lot more. But in my own experience comparing these analogs, they tend to look the same until they don't, right? And then at some point they deviate, and then it seems silly comparing it in the first place. So, we look at the analogs not to tell us what's going to happen, because more than likely it will not follow that path. We look at the analogs to tell us what can happen. I have to imagine that people back in 2006, 2007 felt pretty good about the market, even after all this yield curve inversion, because, we were a year and a half out after yield curve inversion and even uninversion, and nothing bad had happened, right? The market was still holding up, but it did not stop it from eventually rolling over into a recession. And if you look at it for like other things, like other cycles, you can look at like for the dot-com crash, you can see that it didn't hold up nearly as long, and it was just more or less trending down almost immediately. But that's the reason why we look at the bear market stuff and the yield curve inversion stuff, to note that oftentimes after yield curve uninversion, that's where the recession risk is the highest. And during periods of high inflation, you can actually get a recession still during, the inverted yield curve, right? Because the reaction function by the Fed is different than it otherwise would be during normal times, right? There's a lot of headlines right now for layoffs and whatnot. And in normal times, the Fed would have probably pivoted long ago to help, accommodate or go back to more accommodative monetary policies so that people aren't getting laid off. But the Fed actually wants to see a softer labor market. So I don't think that seeing layoffs necessarily concerns them, because going back to a softer labor market would allow for inflation to more durably come back down to their 2% target. Having a tight labor market like what it's been increases, wage inflation. I mean, it's sort of a tailwind for wage inflation, which contributes obviously to CPI, which is not good for the Fed and will, continue to make them want to raise interest rates and to continue quantitative tightening, reducing the size of their balance sheet. So that's why we look at all this stuff. We still have the inverted yield curve. And again, normally it takes a year and a half after a yield curve inversion, for the recession risk to really materialize in the first place. So that's why we're going to keep following this. I know it's a long journey. And again, there's no guarantees with any of this stuff, but I do find it worthwhile to just sort of stick with, what has historically happened and see how it plays out this time. So that's more or less my thoughts on the S&P 500. We'll see if it can get another weekly close above the 20-week SMA and continue to show follow through the rest of the year. If it doesn't, if this just ends up being a fake out, then perhaps the analog from 1946 to 1949 becomes a bit more relevant. And I do think there is some justification to still consider that as a scenario, even if you do get follow through, because even in that scenario there was more follow through than what we've seen, and it was actually quite a bit higher. But one of the reasons is because we are seeing, some softening in the labor market. If you went to go look at like continued claims, you can see that we got another print that was up this week, right? So the labor market is showing that people who are getting laid off are having a harder time finding a job, right? Continued claims continue to go higher. And as we know, when you compare the unemployment rate to continued claims tends to lead the unemployment rate, right? And continued claims are going up, as you can see, and potentially so too is the unemployment rate. So we'll go ahead and wrap it up there. Thank you guys for tuning in. Make sure you subscribe, give the video a thumbs up. Again, check out the sale on Into the Cryptoverse Premium, and I'll see you guys next time. Bye.